today. We will be back tomorrow with Tom, and we'll talk a little bit about the Mount Rushmore finance movies too, which will be a little bit fun. Hopefully it'll be a little bit more of a resumption of normalcy, a little whimsy after a week that's been quite busy. So it has been busy, and we're going to talk about that right now. We're going to start actually off in China. China had some very bad economic data. Now, bear in mind, this is data from November, so it's going to be affected by all those COVID lockdowns. And what we saw was that retail sales were down 5.9%. The previous month, they were down just 0.5%. So retail sales really slowed dramatically for China. That was more than the 4% decline estimate. Similarly, had industrial production that fell quite significantly. Also is down about 5%. Estimate was to be down 3.5%. So pretty bad there as well. And you can start to see why China is moving away from the zero COVID, because it is destroying the economy. You're having pretty weak growth. And I apologize, industrial production in China was actually up 2.2%, but still down from 5% in October. So retail sales down 6%, industrial production up marginally, still lower than expectations. And as a result, China's moving away from the zero COVID, and they're now looking to move on even from the internet regulation. They're talking about allowing Didi to be restored to domestic app stores. This is the Uber of China. That would be a significant step. And they're about to set a GDP growth target of north of 5% for 2023, which would be a pretty big acceleration from this year, which will be probably closer to 3%. So going from 3% to over 5% in GDP growth, at least that's the target for China, according to a Wall Street Journal article, and that will be it for 2023. In the United States this morning, we're also getting some more data. Retail sales in the month of November were actually relatively soft. They fell 0.6%. I'm trying to get the number on what the core number was, but the expectation was for it to be only down 0.2%. And importantly, in October, retail sales were up 1.3%. I would note on the October retail sales report in the United States, you did have fairly sizable stimulus checks that went out in the state of California. I think they were close to about $500 to $600 a person. So that definitely boosted retail sales results in the month of October at the expense potentially of November. Having said that, I was expecting a little bit more of an upward mobility in terms of retail sales in November here in the United States. On the industrial production side, I'm not seeing the numbers right yet. If we get that if we get that before the call ends, I will make a note of that. On the jobless claims, we also got jobless claims in the United States, and that declined fairly significantly to 211,000. Last week, it was 230,000. So overall, some mixed data in the United States, a little bit weaker on the retail sales, but much better on the jobless claims. And it looks like the pump is being primed for growth here over in China. And then also there's a little bit more persistent growth, especially on the employment side in the United States. I'm curious to see how retail sales end up coming in the month of December. But right now, it looks like a little bit of a mixed picture in November. Things did pick up significantly over Black Friday, but the few weeks before that were relatively soft. Talking about the big news from yesterday, Jay Powell and the Federal Reserve reported what they wanted to do from an interest rate standpoint. And they raised rates by 50 basis points, 0.5%, in line with expectations. So now the rate is about 4.5% on the short-term rates. They also indicated that at the end of 2023, the rate would be about 5.1%. This was seen as significantly hawkish because they took that rate up from 4.6%. So taking it from 4.6 to 5.1 at the end of 2023, the market was looking for 4.9%. So you put that all together, and it looks like the Federal Reserve wants to raise rates higher for longer, just as Tom has been pointing out over and over in recent calls. What's also interesting is that they reduced their GDP growth to 0.5% for next year. They were at 1.2%. They've now taken it down to 0.5%. And despite the better economic data, despite, in fact, the fact that they brought down the unemployment rate for 2022, they increased the unemployment rate for 2023. They now expect to exit 2023 at an unemployment rate of 4.6%, up from their prior guidance of 4.4%. They also increased their estimate of core inflation to 3.5%. So essentially what you're seeing is that although the data has been better here in 2022, the Federal Reserve is really looking for more economic weakness and expects more economic weakness as we go into 2023. And they expect that to be a driving factor in terms of their ability to take down inflation. Because again, the most important thing for the Federal Reserve is to bring down inflation. And the way that they can do that is negatively impact the employment market and negatively impact economic growth. So it's difficult to know exactly where the Federal Reserve is actually thinking and what they want the market to think they're thinking. They want to indicate that financial conditions will remain tight for quite a long period of time. Whether or not they actually truly think that remains to be answered, but they are clearly concerned with the loosening of financial conditions in the recent months. Mortgage rates are down about 1%. The stock market is up. That is not conducive to slowing inflation. So we'll have to see what happens with that. But overall, it was a hawkish Federal Reserve meeting. And now the question is, how much does the market believe it? Because right now the market is intent that inflation is coming down, and therefore the Federal Reserve will actually have to cut rates at some point in 2023. And that expectation was unchanged by the market. So essentially the bond market came out and initially responded to Powell's comments yesterday, but then reversed all of that move by the end of the day. And interest rates are largely unchanged. Market-based interest rates are largely unchanged since before the Federal Reserve meeting, which suggests that the market isn't really buying what Powell is selling at this point in time. It'll be interesting to see what stocks do now in light of those moves. Do stocks side with Jay Powell, or do stocks side with bonds? If stocks side with bonds, I would expect the stock market to rally a little bit. If stocks side with Jay Powell, they might be under pressure here in the near term. You also had central banks in Bank of England and the European Central Bank both come out with their policy meetings this week as well. In fact, this morning, Bank of England hiked by 50 basis points to 3.5%. That's a 14-year high. And so did the ECB. The ECB hiked by 50 basis points also. The Bank of England, the big takeaway there is that they're very split. You had one guy wanting 75 basis point increase. You had two people wanting no increases in the rate. And essentially what we're having at England is the economy's remaining a little bit more resilient than they had thought, but they still expect the UK economy to be in recession right now, and that gradually to bring down inflation over time. The European Central Bank, there was a lot going on there. They raised again by 50 basis points, but their rate is still only 2%. So compare the 2% to England's 3.5% to the Federal Reserve's 4.5%. So the ECB is still quite low comparatively. And the ECB is also talking about reducing and actually doing the quantitative tightening. So just like in the US, where we're allowing bonds to roll off and decrease the size of the Fed's balance sheet, that's what they're about to embark on in Europe as well. And so they're going to allow that to decline by about 15 billion euros per month beginning in March 2023, and they're going to reevaluate that in June 2023. I think the takeaway that I have from the ECB is that on a policy standpoint, they're actually being fairly sanguine. The amount of roll-off on the balance sheet was at the lower end of what I thought it might be. the rate guidance was broadly in line with what I thought it would be. But if then you look at the commentary, they now see inflation actually picking up. In fact, they said underlying price pressures across the economy have strengthened and will persist for some time. They now expect core inflation to be 3.9% on average in 2022 and to be 4.2% in 2023. So whereas the Federal Reserve thinks that inflation is going down, the Europeans think that inflation is going up. And that's a core inflation. That's not including energy. And I think that's an interesting dichotomy that I doubt will take place. I think that their inflation accelerates in one location, it'll probably accelerate in another location as well. So I'm very curious as to see what happens with that. Also, interestingly, the European Central Bank thinks that the economy will expand next year by half a percent, which is actually in line with what the Federal Reserve thinks, even though economists say that Europe's going to shrink by 0.1%. So the European Central Bank much more positive on their economy. Apologies there. Finally, we'll just finish it off with Lennar. Lennar is a much more mass market home builder than Toll Brothers. Toll Brothers is very high end. We heard from Toll Brothers a week ago. Lennar was not so good. Lennar is basically going to sacrifice gross margin in order to reduce inventory. Their order book was actually pretty good. Their guidance was good in terms of moving homes, but their gross margin was not. Their gross margin guidance for next year is about 21%. That's significantly lower than the 24% that analysts had expected. And if you look at the average selling prices of new homes for in their order book, you're talking about an average selling price that's now down 11% on a year-over-year basis. Their cancellation rate is up to 26%. That was 21% last quarter, and it was 12% last year. And so what they're doing is they're basically cutting prices to move homes so that their cancellation rates don't pick up even further. So they conclude by saying our sales volume and pricing have clearly been impacted by rising interest rates, but they also say there remains a significant national shortage of housing, especially workforce housing, and there is still demand as we navigate the rebalance between price and interest rates. So that's what Lennar is saying. I'm interested to see what they say on their conference call, which begins at 10 a.m. But definitely the housing market remains very tough. Lennar is taking a very different strategy to Toll Brothers. Toll Brothers is holding price. Lennar is cutting price and maintaining volume. And that also speaks to their business model. Lennar, more mass market, needs to move volume. Toll Brothers, high end, needs to hold the line on price. So with that, let us know if you have any questions. That was a lot of ground to cover this morning. Happy to answer any questions on the central banks, European Central Bank, Bank of England, Federal Reserve, and we'll see what happens in the market today. I think it's going to be a very interesting Rorschach test for the market, given all this commentary that we've seen from central bankers over the last 24 hours. With that, have a great Thursday, and we'll see you tomorrow.